Okay, so here are 5 things that I wish I knew at 20 years old when it comes to investing. So even though I was learning from a very good investor when I was around that age, there's a lot of things that I've learned since that I just absolutely wish that I knew back then. And here they are. So number 1 is if you are in what you would consider is a risky stock. So for example, there was a hard drive company back when I was 20 that I invested in. And it was really early on when it came to SSD style memory, like massive SSD style memory. Like I'm talking like higher than like a couple 100 terabyte type of storages. And they were really in the beginning stages of that and using that type of storage to create big servers. And I was able to double my money in a couple of weeks, and I got out like a snap. I was like, man, I doubled my money. I'm happy. I made $400 in a couple of weeks. I'm gone. And what I should have done is instead of selling 100% of the stock saying, yay, I made my money and leave, I should have sold half of it to get my initial investment back and then to let the other half ride. And then every time it doubles, sell half. Because then you're always making your money back and using it as an income source. I didn't do that. If I left my money in for 2 years and didn't sell any of it, my initial $400 would have turned into about $40,000. If I was to sell half continuously over that period of time, I would have done extremely well over a 2-year period. They eventually sold out to, I think it was WD or one big name storage, either Seagate or Western Digital, one or the other. So that is a major tip. If you're in a riskier stock, sell half, let the other half ride. It doubles again, sell half again, and just keep on going until you're basically down to zero, and then you can be happy or not happy. Either way, you'll have more money than I would, or I did. Either way. Next, second is follow your gut. Because I went to college and I never used my college degree. I went as an educational assistant and I have never been an educational assistant at all since that time. So I said to myself and my parents, look, I can invest this money instead of going as an EA into Apple, let it ride for 10 years, and that like $18,000 would have turned into like $1.5 million. Oh well. Either way, I have a college diploma, and that money was still invested just eventually in myself. Either way, follow your gut, and I'm not saying that you should not go to college or anything. I'm just saying like my past history. I knew I probably wasn't going to use my college degree. I was going to follow basketball anyways. But I still needed to have something to back up on. I guess I can still back up on it anyways. Third tip that I wish I knew at 20 was invest in dividend stocks. When I was 20, I was more into trying to go for the tech stocks that were exploding. And while those stocks did well for me, if I was to invest and reinvest my dividends, I would have done probably even better because I was in some riskier stuff and I lost a little bit of money. And if I was just to go into safe, like Canadian banks, railway stocks, things like that, that still to this day go up. Walmart is another one. Apple, they pay a dividend now, but they never used to. Stocks like that, they continuously go up around the same as the market, if not a little bit better, and you're getting a dividend. And they're increasing their dividend as well. So if you're looking at a Canadian bank and they're increasing their dividend, let's say 10% a year. If you were getting $1 dividend, next year you're getting $1.10. Next year after that, you're going to be getting $1.21. And it just keeps on going like that. And you keep on making more and more money. So that is why I like dividend stocks, and that's why this channel is called Dividend Stocks, and that's why I invest in dividend stocks to this day. I don't think that's going to change. They are generally blue chip stocks. They are safe. As long as you invest in companies that have a good cash flow coming and they pay a dividend and they routinely increase their dividend, guess what? You are in a stock that's going to continuously pay you, and 30 years down the road, that initial stock that was maybe paying you maybe $400 a year is going to be possibly paying you $4,000 a year 30 years down the road. And your initial investment might have only been $6,000. So now you're looking at basically paying yourself back every single year, and your stock is already up roughly maybe 4 to 10% a year anyways as it sits. So, and then if you're younger, you can reinvest that dividend back into the stock if your trading app allows it. So now you're just compounding everything on top of each other, and it's just absolutely fantastic. I started investing dividend stocks when I did a quick short job at Best Buy, but when I was injured, and that I was investing into the Best Buy stock because you're dumb not to at that point, because the stock was at I think it was $18 a share. Now you're looking at $100 and something a share, but they were paying a 1 or 2% dividend or something. And whatever money you put into that stock, the Best Buy was putting money in for you as well on top of what you put in. So it was just an absolute no-brainer to do that. And if you work for a business, this is tip number 4. If you work for a business that has a retirement plan or a retirement pension plan, in Best Buy, as an example, full-time employees can get into it's like a self-directed mutual fund type of retirement pension where you put your money in. Let's say whatever $100 I put in, the company matches it at $100 as well, and you're automatically doubling your money. I think I was at one point doing $200 a month into the retirement pension. They were matching the $200. That's 14 hours or 13 hours that I didn't have to work that they were giving me anyways for the future. So you're almost dumb not to do that. And at that point, the mutual funds that I was in, I was going a bit riskier because I could. They give you options as to which mutual funds you wanted, and some were riskier than others. And I was going as risky as I could because why not? If they're matching, if I've already doubled my money with Best Buy putting money in, if I lose 50%, I don't care. So at that point, it's like found money, in my opinion. If a company's going to give you money for investing, it's just found money. So you might as well go risky. And if you lose 50%, who cares? So I was going in mutual funds who were historically making anywhere between -5% and plus 50% every single year. So even if I lost 5% one year, I didn't care because I was already doubling my money anyways. But if it went up 20, 30, 40, 50%, which some of them were, I'm making a killing. And that is the 4th tip, which is if a company is willing to match your contributions to either the stock purchases or into a retirement pension, definitely do it. It's free money. Do that. And my 5th tip that I wish I knew at 20, which is don't listen to the news. Never listen to the news. Never listen to Jim Cramer. Never listen to any of those people. Now, I've never taken or never listened really to any advice that Jim Cramer has said. I've generally always done the opposite because I disagree with him. But basically, sometimes in the news they'll say, wow, that company is probably going to be having a great quarter, and you're like, oh well, maybe we'll get some call options and try it. And you just have to go by what your gut says. Sometimes, and obviously you have to do your research. But if you're doing a gamble, like you're buying a $400 call option and you're basically gambling your money at that point, do your research, but at the same time, don't listen to the news. The news is generally going to be wrong. So what you want to do at that point is do your research. What's their last couple of quarters looked like? What are the new products? What are they doing? Oh, maybe that quarter might be good. The news said it's going to be bad, but I think it's going to be good. Apple was a great example. I bought a couple of naked call options, and everyone's like, oh, you're stupid. They're going to have a crappy quarter. But in reality, they had a fantastic quarter. I seen everyone lined up for the newest iPad when I was at Best Buy, and I was like, everyone's doing this. Literally, there's you can't get this thing anywhere, and I know they're making a lot of them. And you're looking at pre-orders that were like 2 months behind, and I'm like, man, like they're gonna be making money, and they made a friggin' killing, and I made a killing on that trade. So yeah, do your research, know what you're talking about before you start doing like call options and earnings trading. But either way, I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.